Hello and a very warm welcome to this Investors Chronicle webinar, Stock Picking for Success in Turbulent Times. I'm Dave Baxter, I'm the funds editor on the IC, and today we're going to be getting to grips with what seems to be one of the most challenging times for investors in many years. The optimists among us may have seen 2022 as the year in which the world learned to finally live with COVID-19, the year when economies and societies returned to robust health, and another year in which stock markets continued to march nicely upward. Unfortunately, we seem to have encountered almost relentless difficulties. The year, as you will remember, began with shares tumbling on the back of worries about inflation and the prospect of rising interest rates. The invasion of Ukraine then turbocharged some of those problems, and again we're facing high inflation, rising rates, and now the prospect of a deep and painful recession. People will react very differently to this kind of situation. For some investors, it might be time to hunker down and protect your wealth, while others may be looking for interesting buying opportunities. Either way, we're very keen today to address some of those pressing issues as best as we can. So I have a really great specialist panel today to share their insights. But first of all, I want to cover just a small couple of pieces of housekeeping. Most importantly for me, I want to hear as many questions as possible from you, the viewers. So please do put any questions to us on the right-hand side of your screen, and we'll be getting through as many of those as we can. Do note that this webinar will be available on demand for 30 hours, just a few hours after it finishes. That's available via the same link that you're using now. Also note that useful links, resources, and a feedback form can be found above. So I'm going to now introduce the specialist panel, and then we're going to go through some of those big, broad questions that are of most relevance to your portfolio today. We have a really nice broad spread of experts today, focusing on different corners of the investment universe and different disciplines. So you should get some interesting different perspectives. So first of all, on the stock picking side of things, we have Christian Schneider. Christian works for Allianz Global Investors and is portfolio manager on the Brunner Investment Trust, which is a global equity trust looking to act as an all-weather holding in your portfolio. On the kind of broader fund selection and asset allocation side, we have Ben Seager-Scott. Ben is head of multi-asset funds at Evelyn Partners, so should be able to cover all manner of kind of different questions on the pockets of the universe that he's looking into and what different asset classes are looking troubled or looking interesting. Then looking more specifically at the investment trust world, we have Annabel Brodie-Smith. Annabelle is Communications Director at the Association of Investment Companies. Fans of investment trusts may well be very familiar with the AIC, which bangs the drum for the sector and provides lots of useful resources for investors. And last, but certainly not least, we have Chris Bailey. Chris is the Chief Economist at Celtic Financial Planning. Chris, very happy to have you on board for perhaps more of a kind of macro view on some of these big external pressures that are coming to bear on portfolios. So thank you all for joining. As I said, great to have such a diverse panel with different specialisms. What we're going to do is we're going to tackle some of these kind of big themes one at a time. We're going to work in pre-submitted questions from viewers and questions that come from you now. So please, as I said, do keep submitting those questions to us. And I think the obvious place to start for me is inflation. So, you know, some people may believe or be hopeful that inflation is peaking, and now we're perhaps on a downward trend, but it is still at kind of multi-decade highs in many economies. It's still challenging markets and has big knock-on effects for monetary policy. Christian, I wanted to start with you and just kind of go for the simple question of, you know, investors will be wondering what looks kind of attractive in this inflationary environment if it persists? And what are the kind of weak links in say, an equity portfolio? You know, where are you finding resilience and where are you a bit more concerned?
A very good question, of course, very topical. I mean, inflation in the last 1.5 years has surprised many, not least the central banks, all the time. When we came out of COVID, it was seen as an issue that was driven by the supply chains clogging up and China being locked down. Yet it became more persistent as we went into 2022, and of course the war between Russia and Ukraine clearly made things worse for everybody, at least in the Western world, particularly via the energy prices. Now, it had a profound effect this year on the equity markets. You saw that equity markets dipping. It's simply a technical effect in the first place. Kind of every asset is kind of the current price, the sum of the discounted cash flows that are coming along in the future. And if that discount rate goes up, the prices will fall, and that is what we have seen earlier this year. What's making things worse was simply that on top of the increasing inflation expectations, we saw a rise in the risk premium given the war in Ukraine. We have seen similar effect, and that was dominating the first half of this year. Now, what does it mean for portfolios? Clearly, every portfolio suffered from this downdrift in prices generally as the discount rate rose. What we have to do now basically is look into the portfolios, and we're always doing that, and see the weak links that are potentially out there. I think we're pretty well placed, simply given our quality focus we have in the Brunner Trust. So we invest in companies that do have a strong moat, operate in a pretty calm environment when it comes to competitive pressures, and are typically able to raise prices. So that will be important for companies, and it's important now and will become more important as the year progresses, that you as a company are able to increase prices to avoid margin pressure. So that's a laser focus for us, and I think we're well placed in that regard. And otherwise, clearly there might be even the one or other beneficiary of the current environment, companies that are able to expand their market share if competitors are troubled, and that will be another opportunity.
It's interesting that you mentioned pricing power. That feels like kind of one of the magic traits that many investors are looking for. But say, you know, if kind of viewers are thinking about shares, I mean, are there any kind of key metrics you would look for as kind of a sign or characteristics in a company that would indicate it might have that pricing power?
Yeah, obviously, looking at the profit and loss ratio, kind of you see that the gross margin is the number I would look at, because it is what's left over after you have deducted cost of goods sold from the revenues. And initially, you will see kind of companies cannot increase prices immediately if kind of the energy prices move up, but they will do so in the contracts as you move along. And companies that have pricing power, you will see stable gross margins, rising gross margins going forward. For companies that do not have pricing power and that suffer from inflation and cannot roll it forward, you will see pressure on gross margins. So this would be the line I would look at in the P&L, basically.
And Ben, it might be interesting to kind of look at this from your kind of broader perspective. I mean, you know, when you're thinking about portfolios and you're looking, I suppose, across the whole world of different asset classes, you know, what's kind of standing out to you as perhaps a little pocket of resilience in this very inflationary time? And is there anything that you've just been, you know, steering clear of you think looks really vulnerable?
Well, I think Christian's done a great job of sort of explaining what's happened in the market this year and where we stand today. The way I look at sort of the multi-asset portfolios, you've really got to take a view on what the future looks like. And there has actually been a change. It's not been particularly obvious, perhaps, at the headline level, but expectations have moved from runaway inflation, so future expectations, spiked at the beginning of the year, they've now re-anchored back at a lower level as people have settled on the would central banks, crash the economy to bring inflation under control? The answer we now know is yes. So in terms of where I'm positioned, it depends on if you think inflation is going to stay higher for longer. And if it stays at extremely elevated levels, then frankly, a lot of equity markets are in big trouble. They'll be hit by inflation shocks. And really then your main option is to buy shed loads of commodities and hold on. But that's quite an extreme scenario, I think, as we're sort of heading more towards a high inflation, but not sort of peaked inflation. That's where you can get a lot more opportunities, equities very broadly, as you were talking about just now. Companies that can pass those costs on, those that are a little bit more robust, can fare relatively well. It depends how you think markets are going to evolve more broadly. I think what we are likely to see is the next sort of couple of years, the investment environment is probably going to be different to what we're used to for the last decade. When you're investing with inflation and interest rates not meaningfully different from zero, that's very different to where you can have inflation and interest rate at a sort of material level of even a sort of couple of percentage points. And there, I think, particularly some of the more growthy companies, those that have been priced based on earnings a long way out in the future for mechanical reasons, the higher discount rate tends to punish those a little bit more. At the same time, high inflation and the potential of a slowdown means if you have a company that is particularly cyclical, then those can come under pressure as well. And this is less, perhaps people talk about value versus growth, been a value rally in theory sort of so far this year. But I think looking forward, there's probably going to be a place for some of those higher quality companies and some of those more defensive qualities. I would be a little bit more wary on some of those companies that are a little bit more leveraged and have a much more cyclicality. They are likely to sort of come under pressure, and an inflationary environment isn't really going to help those areas.
Do you think perhaps then, I mean, there are some very popular funds that have struggled in the last, I don't know, this year so far, in the last 12 months perhaps, but they do, focus on not very exciting areas, but areas like consumer staples. Do you agree with the thesis that might be a kind of defensive area going forward?
Yeah, absolutely. I think areas, talking very broadly, I wouldn't say avoid entirely this sector, pile into this sector, but the way we tend to look at it, in those sectors that have a few more headwinds, things like consumer discretionary, areas like investment, information technology, not saying avoid it entirely, but you need to make sure the companies you're picking are able to weather the tougher environment. At a sector level, I think those will probably fare a little bit better. As you say, consumer staples, they're able to pass through a lot of their costs and weather these sort of storms. Areas such as healthcare and utilities, all those areas that have been out of vogue for a long time, can come back in. So I'd sort of favour those areas as we head into a potentially tougher environment.
Yeah. I mean, one area that's, I suppose, always very sensitive to moves in sentiment is, of course, the investment trust space, and we've seen some enormous kind of share price discounts to NAV emerging. Annabelle, I don't know if you had any kind of views on this. I mean, there's always, you always have to be careful not to get carried away with the price tag rather than the fundamentals. But are there any kind of good practices for investors seeing these, bigger than normal discounts and thinking, is it time for me to kind of buy into a beaten up equity trust, or even some areas like logistics that have taken a beating so far?
Absolutely. Well, you're quite right. The average discount is currently 11%. But, we've seen some companies, particularly, for example, the private equity sector, on discounts in the 40s or even 50s. Obviously, the technology sector, again, we've been talking about growth stocks going out to wide discounts. And I think for investors, they need to do their research and need to think about their perspective. What sort of, are they long-term investors? What is their attitude to risk? But, obviously, if you have done that research and if you're buying on a long-term perspective, then some of these discounts may well be buying opportunities. In the past, brave investors who have invested when investment companies, investment trusts have been on wide discounts, have consequently been rewarded. And, obviously some sectors we've got have performed very strongly this year. That's always the case. Things like renewable energy, infrastructure, commodities, hedge funds. And, some of those are on premiums. Some of them still remain on discounts. So there's, for example, the commodity sector is on a 3% average discount versus renewable energy, which is on a 7% premium. And I think, that perhaps underlines a little bit of concern because, obviously we still got very high levels of inflation, but with a predicted recession coming, people are beginning to price that in and think about what the consequences of that will be on these investment companies.
So, yeah, we've had a few mentions of the dreaded R word, and perhaps we should kind of move on to that. Chris, I may kind of draw you in as a kind of economics buff. I mean, I'd be interested in general, I suppose, just to get your view on the kind of inflation debates. I mean, hasn't been the best time for people taking kind of hard stances. Maybe a year ago, people were still insisting inflation was transitory, and that really has not proved to be the case. But do you have any kind of thoughts on what we might be looking forward to in terms of inflation? And equally, you, like others, are you convinced that we are heading into a kind of a deep recession, or do you feel a bit more kind of relaxed about things?
So I think we've gone from one sort of extreme to another in a way. Over many, many years over the last decade, we've seen a dearth of inflation for many good and fortunate reasons: development of the global economy, progress, and related. And suddenly, of course, we have, for a variety of reasons that are not unusual, some of them were unexpected, but we've seen it plenty of times over multiple economic cycles. We've suddenly seen some issues with supply, some pricing matters, and suddenly our year-on-year inflation numbers are very firm. And obviously it concerns any investors, anybody involved in the investment markets. That's pretty clear to understand. Fortunately, what it probably also means is that we are at the peak of the concern at the moment. That's my personal view. And so I would say that inflation aspect will become less of an issue as the next 6, 9, 12 months progresses, which is good news for most investors from my perspective. Then, of course, does it lead inevitably to a recession because central banks are sensibly raising interest rates, or at least most central banks are? And that's obviously another difference from what we've seen as the norm over the last 10, 12, 15 years. And that again is concerning investors and other people involved in financial markets. Reality is, I'd be more concerned if we weren't seeing rising interest rates, because that would be telling me that we would have not just no growth, but actually some other deeper fundamental problems, which means central banks are not comfortable raising interest rates. But I think, as I said, sensibly, most central banks in the Western world and in some parts of the emerging markets too are raising interest rates. Putting it all together, recession fears, they happen. That's reality in economic and investment life. We've been very fortunate, as I've said, for the last 8, 10, 12, 15 years, irrespective of COVID-19 issues and other matters. Reality is, though, that the world still, to me, remains an interesting place, a place which is still becoming, still developing as a global economy. And consequently, am I overly, worryingly economically concerned about the future prospects of the world over the rest of the 2020s into the 2030s? The answer is no. However, that perspective is very much driven from a global view. Clearly, in our own country, in general developed markets, life is becoming tougher. And that's naturally consistent with aging populations, levels of debt, and related factors and progress over the last decade or so. So there are opportunities, but there are threats. That's always the way it is. I guess what excites me is when people are very concerned about an upcoming recession and what it may mean, and are becoming very fearful. And we all know at that point it's better to be looking to be greedy.
So a good time to be a kind of brave investor if you have the right circumstances. I mean, it's interesting actually. One of a question we've had come through is someone simply asked, "Is the old saying buy in gloom, sell in boom?" Which I don't think I've heard before, but saying, is that still relevant? And yeah, perhaps it is.
Yeah, I would completely concur with that, and I say that for two reasons. One is that the economy is a big global place, and even though we've had geopolitical matters which none of us could have assumed 6 or 8 months ago, very sad issues, but fortunately we've seen some general progress too in the global economy over recent years. And some of those general progressing matters is going to clearly continue over upcoming years and the next decade or two. And that makes it of interest to any investors. There is still a big world out there, a rising population, many of whom are becoming richer and ultimately becoming deeper and broader consumers. And that for corporates, individuals, is an interesting place, a place where you can find opportunities to invest your money. So from an economics perspective, there's always trickiness and uncertainty, but also some good and bad performance. That's just the way it is. It's a world of intrigue for me. And frankly, I'd be more worried if people weren't interested in trying to find things to do.
I suppose sticking with, I mean, a lot of our conversation today is going to be macro, given how macro-dominated investment thinking has been recently, more so than in previous years. But another viewer has asked an interesting question I also wanted to pose. The kind of hedge funds, high status personality, Ray Dalio, was recently reported as saying that an increase in interest rates in the US to around 4% would lead to the S&P 500 falling by 20%. I'm going to open this up to whoever wants to kind of take it on the panel, but is that too gloomy, or should we perhaps be prepared for more savagery in markets?
Let me make a start. I mean, I haven't seen the exact statement of Ray Dalio, whether he kind of refers to the Fed funds rate or rather the longer end of the yield curve. The longer end of the yield curve is at around 4%, slightly below, but not far away, certainly. And usually for the valuation of equity markets, the long end of the yield curve is more important because you discount long run cash flows, obviously. Now, I think what he's referring to is an experience we had maybe in the mid-70s when inflation was running high and central banks equally were fighting inflation, raising interest rates, and the impact of the market was much as it was this year. Discount rate rises, equity prices fall, PEs go down. That is a scenario for a persistent high inflation and persistent high interest rates. And of course, if that would happen, there might be more pressure on equity markets from that angle. Now, it's important to look back at the time also. We did a bit of a study there, looking on what happened in the mid-70s, which I was just born actually, so I can't quite remember from a investment point of view, but there are plenty of interesting books and data statistics out there. And you can see that in the 70s, there was an initial boom in oil companies and raw material companies. There was a scenario much like today. The Arabian countries, the OPEC countries, are having a boycott against the West due to a war in the Middle East, and that was sparking that quick rise in energy prices at the time. It's somewhat similar to what we see today. However, later on, it was indeed the more capital light companies that did better during the period, kind of those that didn't have the detrimental effect on their balance sheet, because if you have an inflation, broad-based long-range inflation, your depreciation on the balance sheet is underrating the replacement cost of your assets a company has on its books. So there's a drain on cash flows that was happening then. If we had that, I would look into the same scenario actually, that asset light companies, mostly in technology, consumer spaces, would do better than asset-heavy companies. Much to the contrary, what conventional wisdom is that looks typically at asset-heavy companies in the energy space doing well. So we need to have this in mind, but of course that's only due for a persistent high inflation environment, and we have to see. At least central banks are fighting inflation, taking up the battle, which is good news, much as Chris said. Not ignoring the problem, but taking it head on and bring it back under control is the right approach.
So to stick with one more kind of macro point, Ben, I wanted to put to you, again, just this prospect of recession, looking at it from your kind of broader perspective. Are there any areas that you would expect to kind of fare better in a recessionary environment? And I suppose a trickier question, is there anything that you see as being resilient in both the kind of inflationary environment, but also if things go south?
Difficult one. I mean, as with all these things, there is a solution which is it depends on your individual strategy, of course. There's lots of strategies. One solution is to find good companies that you can invest in the long term, buy them, and switch off your TV. And try not to focus on these things. There is a good sense in not being drawn too much into the short-term volatility and just trying to not play the cycle. I think there are few companies that or few sort of styles of investing that I think would do well sort of in a recession and if inflation that protects you against both. So a little bit of a barbell potentially you can have. For example, energy I think actually looks pretty cheap at the moment. A lot of the oil and gas producers are actually at a fairly big discount. Now, obviously oil's come off, but actually even if oil remains in the sort of $80 to $100 a barrel range, and we've got areas like the US and probably others looking at that sort of level to top up. We know that the Chinese have a sensible habit of mass buying commodities when they dip to a level to build their strategic reserves. So I think even on a normalized basis, energy looks a reasonable environment, and that would help to protect against any exceptionally high inflation. But as you head towards recession, it is those defensive areas I would generally expect to do quite well: staples, healthcare, utilities, etc. But the word of sort of caution that I would put in, you need to remember, markets are complicated. Trying to predict exactly what they will do is not always a good idea. And I could, maybe we could talk later about the nature of risks and the fact it ties to the point earlier about selling on good news, buying on bad. Investing, to my mind, is about embracing risk, and actually it's when markets are complacent you have some of the biggest risks. But the other point that I sort of would caution people on, there is a risk of seeing a recession on the horizon and heading to cash and just de-investing too soon, because you can make quite a lot of money just before a recession and just after. It's the bit in the middle that is complicated. And as we stand today, markets are very worried. Inflation, interest rates, obviously reflected in some of the questions. But just imagine this: if inflation does peak in the next few months, and everyone forecasts this recession at some point next year, there will come a point when inflation appears to have peaked and appears to be trending down, and central banks ease off. And as a recession comes, they will start cutting interest rates to start softening that blow. And that is the potential that a lot of people say, recession, money out, could lose out on a lot of that uptick. So if you are trying to time the cycle, I think remembering there is a point, or hopefully there will be a point, when we're not going, inflation is rising, higher interest rates choke it off. There could be that sort of last hurrah environment. So, be nuanced, be diversified, be exposed to these different sectors. Don't position 100% for here's a recession, here's what will do well, because there's still a little while between now and then.
Yeah, I totally accept your point about embracing risk, but I suppose also you do get people who are either more risk averse and they perhaps need a slightly more defensive portfolio to just kind of help them sleep at night, or people who perhaps kind of at a later stage in their investment journey and need to more protect their wealth rather than just focusing on equities. So yeah, but I wanted to put to you, Ben, and maybe I imagine Annabelle has some points in this as well, but how do we feel about kind of assets beyond the equity space? I mean, one thing I'm interested in, for example, is say government bonds. We've seen yields which move inversely. Prices have moved quite sharply up this year for understandable reasons. But do they now look again like a kind of an interesting safe haven asset, or is it too early to tell?
Is that for me or Annabelle first?
You
Okay.
first,
yeah. Well, I think that's entirely right. And a lot of people ask me, "Oh, is there a recession? Should I be reducing my risk profile?" And I always sort of answer like, "Your risk profile. I don't know what the future holds. Market is about a combination of unknown unknowns becoming known unknowns. And markets go from here when they don't know there's risks, and then drop when they get manifested. And that's what you're embracing. And there are going to be all sorts of unexpected risks that hit markets over the next decade. So you should be positioned from a risk point of view, regardless of whether there's a recession and a massive market effect tomorrow or in 18 months' time. And I think, it is a very valid point. In a multi-asset portfolio, at the low risk part of the spectrum, you may well have a minority of your exposure in equities. And there's a lot of other asset classes that are really viable right now. Within equity, of course, you can have defensive or more aggressive. Outside of equity, and I see there's a question in the box about the 60-40 portfolio and whether or not it's outdated. I think if you go back 18 months, then people would say probably when interest rates are on the floor, bond yields can only go one way and you're likely to experience a lot of pain. That's what we've seen since then. Now that we've had that sell-off, it creates a lot of interesting opportunities, and that's not just in bonds. You've got alternative asset classes, you've got infrastructure, you have a range of absolute return type funds or hedge funds. Now, they're not an asset class, they're a set of strategies. Some are pretty good, others are perhaps less so. But there are a lot of opportunities. I think government bonds are starting to look really interesting. But a lot of people, for a long time, we've had this so-called TINA investment thesis. There is no alternatives. If you want to make a real return, you can only buy equities. Yeah. Now you can actually park some of this, park in inverted commas. You could buy government bonds that can give you, if you hold to maturity, what currently looks like a positive real yield. And for a lot of people, that's what they're after. So I think government bonds in a portfolio, they can finally do some buffering. When interest rates are near zero, there's no buffering. You're not getting any interest paid. Now you can be paid a real positive return to hold those. And if things go wrong, you have some risk mitigation in government bonds. So I think fixed income is interesting for the first time in quite a long period. But it's not just about government bonds offsetting equity. I think in your non-equity portion, there is a lot of interest in credit, and you can, I would favor that sort of shorter duration. So you've got less interest rate sensitivity, but more of that sort of credit exposure, because companies generally are still in pretty rude health, and you get some pretty attractive yields off the back of those. But I would diversify that sort of non-equity portion, not just to be bonds, but to look at some of the alternative asset classes, maybe a bit of gold, maybe some infrastructure, maybe some absolute return in hedge. There are lots of opportunities now. So I wouldn't say the 60-40 is dead. What I would say, you can have a lot more diversification in your non-equity area, and it is worth people spending some time looking at that.
Annabelle, would you agree that there are lots of kind of interesting bright spots in the investment trust space, whether it's some of those kind of so-called wealth preservation funds or alternative assets? But one thing that strikes me about the alternatives in particular is they come with their own very idiosyncratic risks. You've had things like, social housing trusts running into regulatory concerns, or say Tritax Big Box, a really popular logistics trust, has had a difficult time on the back of worries about e-commerce. Does it make sense to kind of try and get a nice spread of those diversifiers just to hedge out those very specific risks that, frankly, I think a lot of people won't see coming?
Well, I really think you've hit the nail on the head there, Dave. Absolutely. You need diversification across these more specialist asset classes. I'm just picking up on something that Ben said. He was talking about gold and he was talking about bonds. And I just think, the wealth preservation companies, companies like Capital Gearing Trust, Personal Assets Trust, Ruffer Investment Company, for an investor, they are holding a defensive portfolio of different assets They'll have some equities, but they'll have some gold. They'll have quite a high proportion of index-linked bonds. And what they're designed to do is, as it says, preserve your capital. So they're not going to shoot the lights out in a strong market, but in the current environment, they are sort of up 1%, 2%. So they're sort of adding some insurance into your portfolio, and you've got a fund manager there making those choices for you. Looking more generally across the alternatives, absolutely, I think, broad exposure. So, for example, infrastructure, investing in roads, prisons, digital infrastructure as well, data centers, fiber. This has been a very popular sector because it can produce inflation-linked income. These companies have contracts, often with governments, and that income they receive rises in line with inflation. So, of course, that's been extremely popular, and it's a sort of 5% yield. They are generally on premiums. The sector average premium is 5%. But you can see why people are interested in that relatively stable income. Talking about interesting things, renewable energy infrastructure, I mentioned earlier, has had obviously a wonderful year, up 15%. They are investing in wind farms, solar parks, energy storage, hydrogen. But clearly, also, obviously, the war in Ukraine, we will have to be more self-sufficient for energy, but also we are looking for greener energy. Now, interesting, the government announcements, so talking about issues, we have the government announcements, we know there's going to be some sort of price cap. We don't have any details yet. I mean, the reality is stability going forward on the price would be helpful for these companies, but they've obviously been making very big profits recently because the energy price has been so high. So, it is a sensible idea to have a diversified portfolio of equities and some of these alternatives. And I have to say, I totally agree with Chris and Ben. We don't know what we're facing, but let's just think where we've come from. We've come from the pandemic, when everything was literally shut down. At one stage, it was, very scary, and the market was plummeting, and we have come back strongly. And that's what I think investors have to remember. We're investing here for the long term. There's always a worry. There's always a concern. There's always an opportunity. Have a broad, diversified portfolio. Don't get carried away with all these economic difficulties and throw the baby out with the bathwater. Keep that diversified portfolio.
Yeah, stay calm, carry on. Ben, I just wanted to come back to you briefly because interestingly, we've had a viewer is not convinced so far by your kind of points on the bond space. They said real yields on bonds and infrastructure are hugely negative. Why are they a good investment? What would you sort of counter to that point?
Yeah, absolutely, and it's a very fair challenge, and it's one of the complicating factors about inflation, how it's reported and how people think about it, backward-looking versus forward-looking. And I mean, you're right. At the moment, with inflation heading towards or hovering around almost double digits, everything's negative, right? On a backward-looking basis, asset classes are facing headwinds. But from an investment point of view, you've got to look to the future and what markets are pricing in and what markets are expecting. And on that basis, we tend to look at break-even. There's lots of different measures. An easy one is break-evens. That's you infer what the market expects inflation to be based on the difference between an inflation-protected security and a nominal bond. And that's how you sort of infer what markets think. I tend to look at the US. The UK is complicated by the RPI usage, which tends to distort things a little bit. But the US, for example, being the global economy, if you look at a US 10-year government bond, at the moment it is yielding around about 3.5% per annum, and on a 10-year view, that the US break-evens is about 3%. So the market is expecting US inflation to average about 3% over the next 10 years, and those bonds are giving you 3.5%. So if you're buying a US government bond, that's 0.5% real yield on a forward-looking basis. So expectations versus what you get. Of course, there's techniques you can use with inflation-protected securities or not to try and take advantage of changes in that expected inflation. But if that is to be realised, and that 3% would basically mean inflation drops but persists above target, which happens to chime with my own view, then you're getting a real yield on those investments. At the same time, so that's when I say you're clipping 3.5% versus 3% inflation. That's 0.5% real return. And at the same time, we talk about those unknown unknowns. At some point in the next 10 years, it's entirely likely some sort of event happens. The Federal Reserve has to say, right, we need to stimulate the economy. We're going to cut that. And then you get the mark-to-market effect. And a very rough rule of thumb, no mathematicians or econometricians or Chris, shoot me, please. But you roughly say you get 1% move for every sort of year of duration. So if you go from, say, 3% down to 0, just because the numbers are easy, that's a 3% move, 10-year duration. That could be a 30% mark-to-market move. And it's that buffering. We saw it in the global financial crisis. Everyone looks at how much the equity markets fell, but at the same time, bonds were rallying as interest rates were cut. And it's that mark-to-market effect that you benefit from in terms of diversification. And in the absence, you're getting that 0.5% real return based on what the market is pricing future inflation, not backward-looking inflation.
So it is perhaps like more of a longer-term opportunity rather than an instant win, which I suppose applies generally to many investments. I wanted to move on slightly from the kind of economics side of the debate, and we've already talked a lot about kind of yields and dividends. Investors are always interested in income, and in the equity space, that seems to have been one of the kind of rare, resilient parts of the market, from things like commodities to perhaps some of your companies that are a bit more kind of slow and steady, not very glamorous, but they do pay a kind of a rising dividend. Christian, I wanted to kind of turn to you first on this front, because I suppose what interests me is that that divide that I've just kind of set out. Do people kind of go for those interesting higher yields, the more cyclical plays, or is it better to go for those kind of slow and steady defensive companies? You to an extent look at yield. I mean, where have you been finding kind of interesting opportunities?
Well, as you know, Brunner is kind of seen as an all-weather fund. So we take a dual approach on it. We, of course, go for dividends. We like dividends and the income stream. And Brunner has 50-year history of not cutting the payout. We have 50-year history of actually rising the payout. But at the same time, investors are also looking for a capital protection and a kind of a rise in the capital they have. And so we also invest in companies that have the ability to grow their intrinsic value and at the same time grow the dividend. So it's a dual approach here. And as such, not just going for the highest dividend yielding companies, because often those are the ones that do not have any growth opportunities anymore, because they kind of acknowledge that and pay out all the cash flows to the shareholder. So our approach is rather to go for those that are able to steadily increase their dividend and both boost that income payment as well as generate some capital growth. Now, how do we do that? Of course, I mentioned earlier, we look for quality companies, those that have a strong moat around them, that have a bit of structural growth and strong cash flows. And very importantly, in these days, I think it was mentioned earlier, we're looking at the balance sheet of our companies. I think in a period where interest rates are rising, that is a very important factor, that because I always see it, and sorry, Ben, kind of the bond side being the dark side of the power for me as an equity investor, because as an equity investor, I receive residual income. So all the money that's left over after the bond holders are paid and the bank is paid. So I need to make sure that our companies in times of rising rates are not overly levered. And much to the point that Chris earlier made, I think it's very important. The period of the last 10 years was rather anomaly. QE was not the norm. QE was there because central banks feared a disinflationary environment, deflation, and a weaker economy. Now, while changing circumstances and the unraveling of QE and rising rates is a change, and change is often not welcome, it simply signals also to us that there is a cost of money out there right now. It's called interest rate. And all those companies that are zombie companies out there that only made a living because rates were zero, kind of lost the right to exist. So a bit of sanity is coming back into the global economy. Weak companies getting pushed out, and the winners will take a greater share of the economy. Very healthy thing that always was there, and I think it's very important and the bedrock of our kind of economies in the West.
I wanted to perhaps return to an economics question, because something's come in that I think is a really interesting point. I hadn't thought of myself. And Chris, I'm afraid, difficult question, but probably one for you. One of the viewers has asked, does the panel think all major economies will go into recession? And they also ask, if so, how long do they think these recessions will last? But I think that's a really interesting point, especially for an equity investor. Is it now time to be kind of looking at that geographic dispersion? And do you believe we will see a kind of several track kind of recession trajectory?
I think we generally do see that, and we definitely will see that over the next year or two. There will be countries out there which do not have a recession. It's just that probably, and I'm thinking here predominantly of leading emerging markets, will have slightly less growth than perhaps people were expecting 1 or 2 years ago in terms of their profile. But this tells us what we've all been kind of talking about, which is that investors have to change. And they have to change because life changes. And in the case of the investment world, the parts of the world which are producing the more growth, the more opportunities for the average company to find new customers and make profits is no longer so much focused on the UK, Europe, or the States. It is now focused predominantly a little bit more on the emerging markets, and that will continue being apparent in the average sector, for the average company, the average sector, as the next decade or so continues. So this is why investment choices, be it equity, bonds, or anything else, does need to factor that in. So for me, am I worried about a recession? The answer is no. It is going to happen in a number of countries, including our own perceptions about what will happen in the UK. Is it a disaster? No, because we've all seen it many times before. And frankly, I'd worry more if we thought we would never have a recession, because that would kind of suggest that people weren't really thinking about the realities of the ups and downs of the investment cycle. But the better news is that there are opportunities out there. But this is why not only the average investor, but underneath that, the average company, the average bond investor, the average commodity expert or related has to approach the world in a different way. And I know that feels tricky in a world which is still unfortunately impacted by some deeply unfortunate events in Ukraine by Russia. But reality is that the broader emerging markets universe remains, to me, attractive for the investor over the rest of the 2020s and into the 2030s, let alone before we discuss matters around green economies and related matters. I guess what I'm trying to say is there is plenty of positivity there. It's not just a negative, oh my goodness, this is a difficult world. It is tricky, but it's not impossible.
Can I also chime in there, potentially an unpopular view, but I think we're so used to recession. It means sharp recessions, weird ones like COVID or global financial crises. Not all recessions are bad in the grand scheme. This sort of cycle where you have mild recessions, not great for those directly affected, of course, but in a broader sort of investment point of view, one way of looking at it is effectively recycling some of that capital from poorly productive and bad uses of capital into new productive forms of capital. So actually a sort of gentle cleansing of the economy is not an entirely unhealthy thing, and it can create opportunities on the other side. So I think we should just embrace them, not always try and avoid them, but accept there are boom times and then there are these periods of cleansing and recycling, and that's not necessarily a bad thing in the long term.
Yeah, so some of that kind of creative destruction, I think Christian alluded to, of your zombie companies we've seen lingering around. Well, yeah, that's very interesting, and hopefully an upbeat note. I am afraid we are now out of time. I'd like to give huge thanks to my panel. Some really interesting points there, I think, and some great insights for investors trying to navigate this difficult time. I'd like to thank our sponsors, the Brunner Investment Trust, whose portfolio is run by Allianz. I'll just remind you that useful links and documents can be found above. Please also do, if you get the time, complete the feedback form. That's really important for us in knowing how to hone these events going forward. I'd also like to draw your attention to an event next month. On the 22nd of October, we'll have another webinar asking what makes a successful tech stock. And for now, I will simply leave you be. Thanks again to my panel, and thank you very much for watching. Take care.